In today's episode of Crypto Over Coffee, the coolest and most caffeinated weekly crypto news show on the internet, I'm talking about the reason why Bitcoin and crypto that follows Bitcoin is down despite key metrics looking actually pretty good. Plus, we've got our usual 404 Logic Not Found segment and a bunch more crypto news, so make sure you stick around for all the updates we've got on the show today. Now, if you like crypto, please subscribe to the YouTube channel, hit the bell notification button as well, or you can follow the podcast on your platform of choice so you get a heads up whenever I post new episodes of Crypto Over Coffee every single Saturday. And better yet, if you're a subscriber on the YouTube channel and you leave a comment on this video, you'll be automatically entered to win a random draw for a Keystone Pro hardware wallet, which is a pretty darn good prize if you ask me. And just a friendly reminder to wrap things up here on the intro, please be aware of scammers that are across all social media platforms. They're impersonating me, asking for money and personal info. So if you get a comment on YouTube that asks you to contact me on WhatsApp, report it, ignore it. Just please be safe. Quick coffee break today is from Red Rooster Coffee Roasters. It's a coffee from Rwanda. All right, so as the headline states very clearly, we're sitting in this period right now of relative discomfort for Bitcoin, and the price is sitting at around 38,000 US dollars, down about 40 some odd percent from its all-time high towards the end of 2021. Many people are ready to just throw in the towel, to just kind of sell here and wait for a re-entry in the 20Ks, and bears think that 20K entry is on the way. Sentiment's a little rough, but not unilaterally, just a lot of people are worried. However, many fundamentals and other metrics paint a much different picture for Bitcoin and what it realistically should look like on the market right now. Let's just take one big thing that I've been tracking for a while: hash rate and difficulty solving proof of work on Bitcoin during mining. So in order to release new BTC into circulating supply up to that fixed cap, each new block mined by miners via proof of work is accompanied by a BTC reward that functions as inflation or release of new circulating supply of Bitcoin. To win proof of work, miners must compete to find an arbitrary hash value through a repeated guessing and checking system where they're hashing using compute resources. As more miners come online and or increase their hash rate to better compete to find that elusive proof of work target and win that BTC reward, the protocol also adjusts the difficulty to make it more difficult, to make that hash challenge more difficult. That adjustment is one of the brilliant pieces of the Bitcoin protocol. Just recently, both hash rate and network difficulty hit an all-time high on the Bitcoin network after a huge drop-off in mid-2021 that kind of almost predicted the closing of the bull market if we're looking back at it now. Many believe that hash rate is a correlated predictor for price, and there's a good reason for that, because the more difficult and expensive it is to mine Bitcoin, the higher the price of Bitcoin must be to support this expenditure. Miners must sell Bitcoin at a higher price to cover the rising costs of earning or issuing Bitcoin. Now, cheaper renewable energy can throw off this metric a bit, and other things as well, but you get the idea. The fact that throughout a period of uncertainty and tumult for Bitcoin and crypto, and regulatory scrutiny on proof of work mining, miners are continuously increasing their capacity on Bitcoin. And this tells me that there's a long-term belief in Bitcoin amongst miners in particular, the ones with the most skin in the game. It also bodes very well for the security of the Bitcoin network, which is another way that this helps Bitcoin. Bitcoin security is derived in many ways from the hash rate required on the network to attack the network being untenably high. So based on this metric, Bitcoin is as strong as ever. And there may even be a disconnect between the price that we'd expect to see based on these metrics and what the price actually is with all the macroeconomic fear right now with aggressive central bank activity and combating inflation. In terms of tangible holders of Bitcoin, the story is pretty much positive as well, to be honest. The speculators have all but disappeared, and you have a huge mass of people who are long-term minded that are holding Bitcoin, long-term investors. We know this because we see Bitcoin leaving exchanges to self-custody quite a bit. We see lots of inactive wallets, and often modest inflows to exchanges in positions to sell, so less inflows to sell. And if we look at whale activity as well, you can see an increase in the number of unique wallets that own more than 1,000 BTC, which is at levels similar to what we saw at the end of 2021, I think in the fall of 2021, kind of near that all-time high. There are plenty more metrics that paint a longer-term positive picture for Bitcoin. So what gives? Why is the price so fragile and frustrating? The truth is, Bitcoin and the rest of the crypto market at large is correlated to the traditional equities markets, like a black hole pulling nearby planets into its depths. The Federal Reserve's hawkish sentiment headed into the May 2022 meeting is a pivotal moment because an aggressive rate hike could send the equities markets into a frenzy and pull all of the crypto markets down with it. So make no mistake, if the Fed lets the equities markets tank to fight inflation, it could be bad in crypto land. Bitcoin could roll into those low 30Ks or worse, into the 20Ks. It can happen. Anything can happen in this space. However, the positive metrics discussed today are encouraging for both a healthy recovery after a catastrophic event like that, as well as a really positive sign for the long-term growth of Bitcoin outside of this short-term negative area. A healthy Bitcoin is a good thing for the rest of crypto as well. So I think that's something we can all get behind, even if you're not heavily invested in Bitcoin. In March 2020, when the Black Swan event happened, bringing Bitcoin down to the ground, it recovered big time. And it did so before the equities markets. And I think the same thing will happen here if the correlation to the equities markets does indeed cause chaos. It'll be one of those short-term pain for long-term gain scenarios. I'm in Bitcoin for the long term, as I am with a broad set of cryptocurrencies, so we are in this together. Now, to sort of pour some additional fuel on the positive news for Bitcoin thing, early this week, some interesting Bitcoin news broke that actually really surprised me. And that was news out of the investment behemoth Fidelity Investments announcing upcoming support for Bitcoin in 401k plans on their platform. So Bitcoin in retirement plans. Fidelity is the US's biggest retirement plan provider. So the announcement that retirement plans will be able to be configured for exposure to Bitcoin by mid-year 2022, so very soon, was a pretty welcome surprise. And this is just another checkbox on the proverbial adoption clipboard or whatever you would call it, and it certainly will not be the last big name to open the doors to this type of thing. What really surprises me about this, though, is that despite the very vocal regulatory response to crypto and retirement plans lately, Fidelity did this. I mean, Bitcoin's probably the least risky in the crypto world right now, on a long time scale at least, but it's still a volatile beast with downside risk and short time scales. On one hand, I kind of agree with the regulators in some ways because the average person who might do this and put Bitcoin in their retirement account may not give enough credence to the short-term risks involved in this space, but at the same time, I'm heavily invested in crypto for my own retirement, so who am I really to talk, right? What's more interesting to me, though, is the reasoning that Fidelity had behind this offering, citing, quote, growing interest from plan sponsors for vehicles that enable them to provide their employees access to digital assets in defined contribution plans, and in turn from individuals with an appetite to incorporate cryptocurrencies into their long-term investment strategies. And this is quoting the head of workplace retirement offerings and platforms at Fidelity Investments, Dave Gray. And credit to CNBC for that quote, by the way. That says to me, that quote, that this product is not Fidelity trying to be cool and push the envelope by delivering an experimental product or feature to just kind of see what happens. They built this in response to customer demand. And that says something about the continuing evolution of Bitcoin and crypto into the national zeitgeist, into the global zeitgeist. This only says good things to me about the long-term outlook for this space. We're really early, folks, but we may not be early for much longer. I mean, if you're watching this video, you can still say that you were early. We were early together, but the next generation may not be able to say the same thing. Now, speaking of crypto retirement accounts, Crypto Over Coffee is brought to you by iTrustCapital, where US-based crypto investors can invest in crypto in a tax-advantaged manner within an individual retirement account or IRA. If you want to add crypto to your long-term crypto investing toolkit, of course, knowing the risks, you can earn a $100 Bitcoin funding bonus by signing up via the link in the description and pinned comment. Thank you to iTrustCapital for making this show possible. Now, one project that I just came across while doing research on other stuff is a privacy-focused project that caught my eye when I first read about it. And that project is called Findora. The open source project Findora is coordinated by a foundation of the same name and an organization called Discrete Labs, which is pretty fittingly named itself. And this project's been active since 2021, at least from what I've been able to find online. The goal of the project is to build an Ethereum virtual machine compatible network layer with privacy by default for users to transact Ethereum-based tokens in a private manner across EVM chains. Now, this design relies on the core Findora blockchain network itself and an EVM smart chain layer as a connector for executing smart contract operations and transactions with zero-knowledge proofs under the hood, providing that privacy without sacrificing verifiability, which is a fundamental principle of blockchain-based privacy. Findora's focus is, of course, the DeFi space, but I'm sure this technology can and will be expanded to other areas of the execution environments in the crypto ecosystem, NFTs and things like that. That said, this project just recently went into its testnet named Yellow Submarine. Yes, the Beatles' Yellow Submarine. I think it's named after that. And I'll be watching pretty closely to see where this lands in mainnet. As Findora's docs allude to, they're trying to build this ecosystem for PriFi, a privacy-centric decentralized finance. So really interesting stuff, and I've got plenty more reading to do on this technology, and I'll be doing so. Now, Cardano fans will also be pretty pumped because this past week, the hardware wallet manufacturer Ledger announced the launch of the version 4 release of the Cardano app for their hardware wallet products, which gives users the ability to interact with Cardano decentralized applications via their Ledger device. And this was a huge missing piece in this ecosystem. At face value, this seems like a really small thing, but it's a monumental thing in reality because the level of effort to onboard non-EVM chains to a hardware wallet with full support is no small thing. With the ability to sign smart contract invocation transactions using hardware, the entire Cardano ecosystem gets that much more mature, and more importantly, that much more secure. So if you're not already using hardware for the brunt of your cryptocurrency usage, you really should be, and Cardano fans should now be jumping fully on board to use a Ledger wallet with this new update, letting you interact with Cardano DeFi and other dApps on mainnet. So if you're already using a wallet for your staking and delegation, which you should be, now you can use it for dApps. If you don't already have a Ledger wallet, you can also support the channel by picking up one using the affiliate link in the description, but there is zero pressure on that either way. Feel free to just go straight to Ledger's website. Now, I've also talked about Celer network on the channel a couple of times, and another segment on the project has been long overdue, to be honest. And this past week, the layer 2 turned blockchain interoperability protocol Celer network launched something that I couldn't not put in the show. And that's a double negative, I know, but I did it. Celer network allows users to perform DeFi, NFT, and other on-chain activities across nearly 30 different blockchains via their Interchain technology stack, which just got a huge upgrade on mainnet in the form of the Interchain message framework, or IM framework for short. Now, this tool allows developers on the Celer network to build powerful interchain dApps, triggering multi-chain actions from one single blockchain transaction. Now, this sounds a little bit mind-bending and a little bit simple at the same time, and it is, but this tool has tons of potential. The first great example of how this is being used already is in the Interchain chain hop liquidity protocol, which, according to their documentation, can use the aforementioned Celer network tools to convert a token on one origin blockchain to another token on a completely different blockchain with only one single signed transaction. And you know me, I like technology. Celer is building some really cool stuff that builders can then use to build other cool stuff. You get that flywheel going, and it solves for the user experience and adoption challenges in this space, and I can always support stuff like that. Now, it is also time for Rational Reactions, a segment on the show where I read headlines from crypto publications and give you my instant rational reaction to what's being said in that article. So let's go ahead and switch over to the computer and get started with the Rational Reactions segment. All right, we got the first story of the day all queued up. It is from Cointelegraph. Goldman Sachs offers the first Bitcoin-backed loan as Wall Street embraces crypto. The subtitle reads, Goldman Sachs has offered its first Bitcoin-backed loan, showing further signs of increased interest in cryptocurrency from Wall Street institutions. So you kind of start to notice a theme in this episode here, where you start to see all the fundamentals falling into place for Bitcoin, more adoption. And this is also for crypto. It's not just for Bitcoin. More adoption, more open-mindedness from Wall Street. Some regulators starting to understand this space a little bit better and make better decisions in this space. Not everyone, but some. This is good. So Goldman Sachs offering this Bitcoin-backed loan means now, similar to someone who is very wealthy in equities, can now do the same thing. If you can get lending with your crypto as collateral from a Wall Street entity, that's a huge change. That's a huge change in sentiment to what used to be yeah, that doesn't count. Those assets are volatile. They could be gone tomorrow. We're not going to count that as an asset that you can use to back a loan. I mean, if you think about it, think about what a lot of people do in their lifetime. They buy a few big things. They buy cars, they buy houses. Maybe they're doing investing, so they're buying more than one piece of real estate. If I could use my Bitcoin, which is a large portion of my net worth, to secure loans, that would be huge, right? That would be a massive thing that you can't do right now. If you go to get a mortgage right now in the United States, it's as if your crypto doesn't exist. They don't even want to hear about it. Frankly, maybe it's a little bit of a questionable conspiracy-esque thing, but I think maybe that counts against you in some ways if you have crypto. But the reality is, this is big news, and we should be celebrating the fact that Wall Street is starting to figure this space out. I know a lot of people may not like it, but that is true. The second story of the day is also from Cointelegraph. Bipartisan bill to give CFTC authority over exchanges and stablecoins. The Digital Commodity Exchange Act would give the commodities regulator the authority to determine rules for cryptocurrency developers and exchanges offering spot trading. The way that I initially read this, and I haven't done a lot of deep research on this, so please, I'm doing a rational reaction here. I haven't done a lot of research yet. But what this says to me is maybe the SEC's role would be formally diminished on some of these areas. And I think based on the current climate right now, and of course things can change, I would like the SEC to be as far away from some of these things as possible. I think there's been a little bit of push and pull between the CFTC and the SEC, like, hey, this is my area. No, this is my area. That's not good for anyone because it does the opposite of create regulatory clarity, which is necessary. I think at least the CFTC makes more sense to regulate and to rule make and to focus on some of these areas. And I would be more optimistic if the CFTC were to be formally identified as the rulemaker in this area. So that's just my initial take. Things can change. I'm going to do a little bit more research on the ins and outs of this bill. I haven't had a chance to read it. It's on my list of things to do. This story only broke yesterday on the 29th of April. So I got a little bit of time. Maybe next week I'll do in this show a full dive into that bill. So thank you. And this last story, and you know what, CoinDesk, you need to fix your website. This banner at the top keeps jumping in my way. It's really annoying. Anyway, the headline reads, Wall Street's latest, quote, market manipulation scandal should be a wake-up call for crypto. Archegos, I don't know how to pronounce this, my apologies, levered a small basket of equities to the moon before it imploded and took big stocks down with it. Similarly, overlooked risks in crypto could leave traders holding the bag. Now, a lot of people probably read this and like, oh, it's so negative to crypto. I don't like this. Okay, well, it's actually true. There's a lot of market manipulation in crypto. And I'll tell you right now, a lot of the bigger organizations in this space and regulators, that's what they're going to be looking at to characterize the whole crypto space. And that's not what we want, right? You don't want the whole crypto space getting the same bad rap now that a lot of Wall Street folks have with the everyday person. A lot of people have a very negative connotation when you say Wall Street, right? We don't want that same negative connotation happening in crypto. And there is today, because this market is so small and because a couple of really big players with a lot of resources can completely manipulate the market, this is also something that needs to be called out, something that people need to focus on and think about. When you're looking at a lot of like brand new altcoin projects, market manipulation is all over the place. You have big entities in the very beginning doing all sorts of stuff to try and enrich themselves. And of course, there's now things for private sales, and you've got vesting schedules and cliffs and all these things, you know, the fair launch. But in reality, there is still a lot of market manipulation after the distribution of tokens, and that's just the way it is. So we need to obviously continue to track towards more maturity in the crypto markets, and we will get there. But this article actually, which I would actually encourage you to read beyond just the headline, because I actually just read this article the other day and I'm coming back to it. This was posted yesterday. I read this yesterday, thought the headline was really relevant. So That's going to do it for Rational Reactions. Let's move on now to 404 Logic Not Found and talk a little bit about that. I think you might find it pretty interesting. Now, ladies and gentlemen, it is time for 404 Logic Not Found, and for those of you who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And speaking of attention, if you want to help this episode of Crypto Over Coffee get some attention from the algorithm robots, please hit the like button, get subscribed, follow the podcast, share this with your friends, because it tells those robots that you're enjoying the content and therefore others might also enjoy it, and it helps me. So thank you very much for that in advance. And a quick little coffee break. If you're drinking coffee, join me. Now, today's piping hot slice of humble illogical pie is really focused on a phenomenon I've seen play out countless times in my years and years in this space. And that phenomenon is the startling multiplication and repetition of every remotely good idea in the crypto space. As soon as there is a success story for something like a new decentralized exchange model or play to earn, whatever, you then see hundreds of copycats appear out of nowhere talking about being the next generation of that idea. I mean, let's be real. We don't need 5,000 decentralized exchanges per blockchain. We need maybe a few per blockchain for competition purposes, and the door's always open to innovate. But we do not need 100 liquidity leeching copycats with no intent on innovating or creating anything new. And we saw this with every DeFi niche, play to earn, NFT PFP projects, NFT mini games, blockchain games, and now we're seeing it again with this whole move to earn thing with STEPN in the Solana ecosystem. Just you wait, there will be at least 10 to 20 versions of that being pitched on crypto Twitter in the next week, if not more, and they will be exactly the same as STEPN. They will not even change anything. It's like Gremlins or something. Once a concept starts to hit, it just starts multiplying, and all of a sudden there are just tons of little monsters running around trying to snatch up liquidity from every altcoin buyer they can get their grubby little claws on. I really long for the day where cash grabs and copycats like this never see the light of day because they can't cut through the noise, but that will likely be a long way away. My main issue with all of this is that it dilutes and degrades the overall value and ethos of the crypto ecosystem when every good idea is squeezed for every last penny by shallow copies. Like a good song, there will always be a semblance of borrowing from or deriving inspiration from something that's been done before, but a clone is a clone. And it's a 404 Logic Not Found to basically steal from people by raising money for a clone project where all you changed was the branding and the name. If you're changing something about it fundamentally or you're innovating on that idea, great. But otherwise, I would question it immediately. And I don't mean to imply that everyone in this space is just copying each other, but I mean, that's happening a lot. There are tons of great builders and innovators out there, but it's like 10 to 1 in terms of like copycat projects to new and exciting things that have a chance of doing anything special. And that ratio is being very generous too. 10 to 1 is probably more like 100 or 1,000 to 1. I mean, I'm rambling now, but the bottom line is this. Gremlins are bad. When they start cloning and stealing your crypto, they're even worse. And we don't need copies of every good idea that we create in crypto that don't change anything about the underlying idea. Boom. Simple as that. Now, folks, let's go ahead and do some community Q&A, and I always answer questions from folks who watch the show, and I've got some questions from last week's episode that I'm going to answer here, and I want to remind you that if you have a question that you want answered, and any question goes, leave them in the comments below on YouTube, or you can tweet me at Hashoshi4 as well, and I've left a link to my new TikTok profile in the description box below, so if you're on TikTok, I'm going to start answering questions there in super concise 1-minute answers. So with that, let's dive into these questions we've got for the show today. All right, we got the first question of the day here from Christopher Payton. Love the show. Feel you always explain things in a that photo just fell. Feel you always explain things that make sense to non-tech. Can you explain staking in layman's terms? So staking is pretty simple. Staking is this mechanism to draw participation in on-chain governance. So that's things like block making, so creating blocks of transactions, so securing the network, and making decisions on the network around referendums and new updates, new protocol upgrades, and things like that. So staking itself is representative of a methodology within proof of stake. And proof of stake basically derives security from skin in the game, right? So let's put it this way. In proof of stake, when I stake my cryptocurrency and I lock that up in some sort of staking contract, and it's not always a smart contract, but it's a protocol function. If I lock it up and I know I can't get this out for 21 days after I stake it, for example, and my stake goes directly towards supporting a block maker through a pool or a validator pool, or directly I participate in block making by staking. Different varieties of the same thing. Now, in this environment, I am in a sense disincentivized as a staker to participate in any malicious activity or support a malicious validator who's going to be making blocks of transactions, because two things. One, I want to get rewards. So by staking, as blocks are made, you get a cut of those rewards for moving the network forward. And two, I have staked assets in this ecosystem. So if something were to happen on this ecosystem, malicious activity on the blockchain, what have you, that devalues the currency I have a stake in. So that's that skin in the game. That's the whole fundamental principle of staking, whether it's direct governance, where I, as a staker, am validating and participating in block making myself, or if I'm using a validator pool, like something like Cardano, or in many cases, other proof of stake blockchains out there right now that use that same pool mechanism. Regardless of that, the skin in the game is what protects the network from malicious activity. It's an economic disincentive. Now, a lot of people also ask where the rewards come from for staking. You know, hey, it's great, we're making blocks of transactions, we're moving the network forward, but where do those, X number of tokens come from that I get paid in when that happens? And that often comes from a treasury. So it's a central treasury in the blockchain protocol's design, and that treasury sort of pays out. You can think of it like a security subsidy, where it's paying out rewards to encourage good behavior and continuous activity on the governance side of things within a blockchain network. And so if you think about it, you'll have transaction fees feeding that treasury, and that treasury then being used to pay people to continue to use the network and govern the network. So that's sort of proof of stake in a highly simplified and generalized view. There are obviously specific flavors and implementations of it, but you get the general idea. Thank you for your question. Second question is from Crypto Portfolio Hodl. The bear market is where wealth is made. Just ask people who sold Bitcoin around 60K and then ask those who bought in the 60K range. This is more of a statement than a question, but nonetheless, it's important to note the bear market is where millionaires are made. The bear market is where not even millionaires, but if you're investing with $100, that's where thousandaires are made, right? The bear market, when you want to adhere to the buy low, sell high sort of markets strategy, the bear market is the time to be buying in, not buying at the top. It's just really hard to time the market. So yes, this strategy is important, but you also need to be very careful about the risk that you're putting yourself in and how much money you're putting on the table, and never invest more than you're willing to lose. Because even if you think, oh, I'm in the bear market, I'm going to make money now, you could find out that you were wrong. It wasn't the bear market after all. There's more downside, and then you get hurt. That's not what anyone wants. So this sentiment is good, but you also have to still be careful the way that you're approaching this market. And finally, we've got a question from Sean Dawkins. What does anyone think of crypto earn platforms? What are the risks for them if we go into a recession? So here's the thing. Let's focus more on the centralized crypto earn platforms, because the decentralized ones are a little different. And I think that's too much scope for this question for this particular type of format. There's not enough time. The centralized earn platforms, we're talking like the Ledins of the world, the Celsiuses of the world, the BlockFis of the world, those types of earn platforms where you're earning yield on stable coins and cryptocurrencies. All of those platforms sort of function in terms of their revenues like banks. They're loaning your assets out to probably institutions who are earning yield, and they're paying interest to utilize that, and they're sort of passing you the earnings from those relationships that they have. So they're generating yield from the cryptocurrency that you're effectively lending them, and then they're giving you that yield back. When the markets are not good, so when there's a recession, like a recession in the equities markets in the traditional space hurts crypto. And you've noticed if you're on these platforms, yield rates are just going down and down and down and down and down. Everyone is reducing yield rates, and that's because the markets just aren't as good. So at best, you're probably going to see in a formal recession, you're going to see yields going down on these platforms. They're going to be offering less yield because it is higher risk environment. And secondly, there's just less activity. There's less actual earning that they can share with you. The second thing that you need to look out for is these platforms are not without risk, right? You can see these things go belly up because, frankly, assets get lost or trades don't work out. There can be defaults. There's all sorts of stuff that can go wrong in this space, or there are assets sort of out there and someone wants to basically come and claim a large amount of Bitcoin. There's not enough Bitcoin in reserves to cover that, right? There's lots of things that can go wrong. Like with anything, there's risk. So you need to be very careful about these things and not treat it like a bank account, because it isn't like a bank account. There are risks, and you need to be very clear with yourself about what those risks are before you dump a bunch of money in. I know a lot of people who treat a USDC savings account on Celsius like a bank account. It's not a bank account. That money can go away, and it's not FDIC insured, right? So you need to be very careful. That being said, I know a lot of people use these platforms. They're great platforms. I use them. Just be very careful. Now, I want to thank you so much for watching this episode of Crypto Over Coffee. If you got some time to stick around, please check out this video I have linked on the screen. I think you're really going to like it if you're into crypto. And of course, I wish you and your family a wonderful rest of your weekend and week ahead. And until next time, cheers.